So, good evening, good morning, and good afternoon to those who came and dedicate from them time. My name is Gibbesch, and I'm the founder of Gibbesch Consulting GmbH, which is a boutique relocation company agency. And we are helping with relocation process for people from all over the world moving to Germany. We work all over Germany. And we assist also with residence permit, but mostly with relocation itself, mostly from your home country to Germany. And today we're going to talk about understanding the German pension system, what Americans in Germany need to know. We're going to talk about public, private, and company pensions. We're going to talk about what expats should know about the US-Germany Social Security Agreement, and about strategies to optimize your pension planning while living abroad. I'm very, very happy to introduce Mr. Ryan Mcrae, and he will introduce himself. So, Ryan, the stage is yours.
Thank you very much, Tal. Let me just, there we go. Perfect. So hello, everyone. Hope everyone's having a good weekend. Thank you very much for coming along. And for those who are also later viewing this online, my name is Ryan Mcrae. I'm the Senior Wealth Manager at Senior Wealth Advisor at LEX-Wealth. I'm originally from the US myself also. So, I've got that experience of being an American, know what it's like living and working overseas. And I've worked with expats for many, many years, not just with LEX-Wealth, but I also have previous experience in very large banking institutions like Barclays Wealth, Lloyds Bank International, as well as Santander. Okay, so as Tal said, today we're going to be walking you through the German pension system. As a US citizen living overseas, things do work a little differently. Most Americans living overseas are going to know this. So, I don't want to obviously, rehash things that are clearly available online. The main thing, though, that impacts us as US citizens are the reporting obligations back to the US whilst living overseas. This is because of FATCA, also known as the Foreign Account Tax Compliance Act, which was set up basically to prevent US taxpayers from hiding money in foreign accounts. Unfortunately, though, it has become quite burdensome for US taxpayers. It's made it much more difficult even to access financial services whilst living abroad because a lot of companies, abroad simply don't want to have to comply with the FATCA reporting compliance back to the US because it's costly and it's overly burdensome for them. So a lot of Americans even have difficulty accessing basic things like stockbroking accounts. Extremely, extremely difficult to find a provider. There are a few, but again, we'll cover off some do's and do nots shortly within the presentation. But yeah, it's just very, very burdensome. There's only actually two other countries in the world that do this to their citizens. Eritrea, but it's like a 2% tax that they apply, and Burma, if you can believe it, they've got like some really limited rules about taxing certain citizens abroad, but in truth, it's rarely ever enforced. So yeah, it is definitely more challenging as a U.S. citizen. It's also more costly because not only do you have to do you're living in Germany, you do your taxes back to the Germans, etc. You're also as well having to do your taxes back to the US. And on a lot of occasions, you're having to pay two different tax advisors. So again, it becomes even more costly as well. You also have other reporting obligations as well that need to happen every year. Then that's known as EFPA, where you have to also go and report accounts that hold over 10,000 euros, etc. But let's have a look at we'll first of all we'll have a look at the system. Okay. So I'm just going to share my screen. If you just give me 1 second. I'll give it a second to to make sure that it is being shared. I'll just, we'll get rid of that. Okay. So, yeah, we'll do a little walkthrough of the US system, German system, and then I'll walk you through a couple of little bits as well. Okay. So hopefully you can all now see my screen. As I say, been working in Europe for quite a long time with expats. I mean, it's literally been over 20 odd years. I'm a qualified European financial advisor. I also hold qualifications in things like governance, risk, compliance. I've previously given mortgage advice, financial advice. So yeah, we'll give you a little bit of overview first of the U.S. pension system. So in the U.S., you'll all know you've got Social Security, which is the main state pension, I guess, as you would call it. Typically, it can be claimed from age 62 at the earliest point in time. However, though, if you do decide to claim it at age 62, then effectively your benefits get reduced. Full Social Security these days, I mean, for anyone born after 1960, it's now actually moved up to age 67. And generally, you know, with that's when most people are going to basically be able to get their full Social Security benefits. You can actually then delay it and actually increase the benefits further. Although maximum age you would be able to delay and actually get extra benefit will be age 70. You generally need to have at least 10 years of contribution in order to qualify for Social Security. I personally know this because actually, in fact, I only have 9 years, so I don't currently qualify, unfortunately, which is a bit of a shame, but it is what it is. So, I mean, with Social Security, like a lot of the state pensions, and again, most people will have seen this online. You know, anyone that follows the news, what's going on with, you know, politics, etc., will have seen that, you know, the most state pension systems, certainly in the West, are under a lot of pressure. They're under pressure quite simply because we are living in a society that has a very, very aging population. You know, most boomers are kind of now boomers. Most baby boomers are now, you know, mainly retired or certainly coming up to that kind of final stage of retirement. After that, however, you're going to have Generation X, which is my generation, and it's going to be a huge proportion of the population. And you know what we're seeing, you know, across many countries is aging population and less children being had. That is fundamentally changing our demographics, and you know, effectively, there's going to be there are less and less workers per pensioner, and it's just basically causing bedlam when it comes to funding these state pension systems. I mean, I mean, you can go and Google, you know, and read about this, but you know, Social Security trustees, I've seen many articles about it that have basically said that the actual trust fund that's set up could be exhausted around 2033, 2034. Um, and if it happens, you know, unless, you know, basically there's legislative change in the US, benefit payments could be cut by like 20, 23%, give or take. Um, and, you know, it's not unique to the US, though. There's pressure across a lot of different state pensions. In the UK, they've already announced that it's moving to age 68 before you'll be able to get it. Denmark actually recently passed a law that is raising the state pension age to age 70 by 2040 for those born after like 1970. It's also projected as well that a number of countries are going to have real issues. I mean, if you look at countries like Italy and Estonia, Denmark, you know, where they've got a really high life expectancy. Denmark's talking about 74. Italy and Estonia could be 70, 71. You know, the list goes on and on. I mean, you can even look at countries like South Korea, where the birth rate is just so low, and it basically is creating havoc. So it's something to be mindful of. You know, and certainly if you're going to be retiring in the next 10, 15 years, it probably isn't going to impact you as much. But for those who are younger and, you know, might have 30 or 40 years until retirement, it's certainly something that you need to keep in the back of your head if a large proportion of your retirement planning has to do with relying on state pensions. Because quite frankly, the state pension might be, you know, dramatically reduced in the future. And that's not to kind of freak people out. That is just what the reality is. In the US as well, obviously, you've got 401ks, you've got IRAs as well. As you'll see here, you've got various contribution limits. One thing to bear in mind is these are great, from a tax efficiency point of view in the US. However, though, and we're not tax advisors, but we know this. One thing you have to be mindful of is when you draw this down, in the future, if you are resident in Germany, the Germans are going to tax you on, okay? And effectively, somebody taking, or as an example, 100K drawdown out of a 401k or an IRA, effectively, you can expect to literally nearly pay tax on a third of that. The tax will equate to roughly about a third of that money. So, I mean, $100,000 is roughly around 90,000 euros. You probably end up paying somewhere around 30,000 euros of that in taxes when you draw it down, because the Germans don't recognize these schemes. Okay, they will tax you on worldwide earnings. There is a tax treaty between Germany as well as the US. So the good thing is you will not be taxed twice on the same money. Okay, but Germany will definitely tax you on any earnings that you are taking from the US. There's no getting around it. As I say, and it's kind of a bit of a shame because, like I say, they don't recognize this, but I guess that's what you're giving up for living in Germany. They want their cut, so to speak. And in my opinion, German tax authority, they are pretty aggressive in pursuing monies. So it is always advised to report your correct taxes to them. All right. So let's have a look at the German pension system. Okay. So in Germany, much like the US, there is a state pension. Okay. It is known as, in the short version is DRV, otherwise known as the Deutsche Rentenversicherung. Okay. And essentially, if you're an employee, you will pay into this as well as your employer paying into this. It's basically going to work out about 20%. And essentially, you pay half, your employer pays half. It is tax deductible. The pension system itself, it is a points or credit based system, much like the US Social Security, where you need 10 years and they basically are giving you credits for every quarter that you work. How it works in Germany, it is based on how much your gross salary is, or brutto salary, as it's known in Germany. And essentially, to get one credit into the system in Germany, I'll just show you here a little website, which is their official website. Basically, to get single point, you now need to have an income of 50,493 euros gross, and that will earn you 1 point. Okay. And how it effectively works is each point. Okay. So you'll see, I mean, just depending on how many points somebody accumulates over the lifetime of their contributions, each point currently is worth 40.79 euros per month in retirement. This does get regularly adjusted. There is no guarantee, however, that it will keep those adjustments will keep pace with inflation. Obviously, that is the hope. Okay. But to again give you a little bit of background here, this 50,493, used to be around 43,000 euros and has dramatically increased. And the reason why it's increased is simply, again, because of state pension, pressures on the budget. The median gross salary in Germany is somewhere around 43,750. And effectively, what that means is a lot of people basically not even accumulating 1 point per year. And it means, if you're an expat, you come over here and let's say you've got 20 years that you pay in, effectively, you might be able to expect somewhere around 815 euros in retirement. Obviously, though, if you are a higher earner, and let's say you basically are getting the maximum number of points per year, which is 2. Okay, so if you're earning 101,000 basically, then the maximum amount you can accumulate would be 2 points. And in that case, somebody who had 20 years of contributions, getting those maximum 2 points, is going to kind of end up in today's money, roughly around 1,600 euros a month. which sounds a little bit better, but certainly, it's for most people, it's not going to be enough. And bear in mind too, you also need to pay tax on that income as well. So, it's something at least. But for most people, it's not going to be enough. And quite often, to get the level of income most people want in retirement, they basically need to, do something else outside of the state pension. Okay. And that's kind of where LEX-Wealth comes in, because and we can help you with things like these sorts of calculations. We can also help with, looking at things like existing pensions you might have overseas, other pensions you might have in Germany, etc. Pulling them all together, running through some calculations with you, really, really make it clear from your perspective. This is what I have. This is what I might, be expecting, and based on what I'm hoping to achieve, this is that differential, and how much basically that I'm hoping, so how much that I might need to basically be contributing in order to reach the level of income that I'd like later in life. The other thing to bear in mind too is the German state pension is age 67 is the age of retirement now. A lot of people don't want to work to 67. I mean, as much as I love my job, I don't want to work till 67. 62 is kind of my number, that I think kind of, I can keep doing this job effectively, well, etc. And, at that point, I think I want to enjoy my life. Everybody's different though. Some people might want to work until the day they die. That's okay too. It's not a problem with that. But it's that kind of discussion that we have with our clients. And, the other thing too, you need to think about age 67 is health considerations. A lot of people by age, 65, can't do the jobs that they were doing, in their 30s, 40s, 50s, simply because of health considerations. So hopefully, however, we, hope to see increased life expectancy with things like AI coming out, et cetera, new health advances, so on and so forth. But, the reality is most people don't want to continue working, when they're 70 plus, and certainly in my experience. But like I say, everybody's completely different. So with the DRV as well, there's not a lot of flexibility in the scheme. Okay. So it is possible to effectively go and get the money before age 67. However, though, you need to have made 35 years contribution into the state pension in order to do that. If you are able to do it, then the earliest you can take it is age 63. And if you do that, then for each month that you take it early, you are effectively penalized by a 0.3% reduction, on what you would have expected had you worked until age 67. So effectively, if you decide to take it at 67 rather than 67, you decide to take it at 63, effectively it's roughly around a 14.4% reduction. And as well as that, obviously, there would be 4 years that you would not have contributed into the pension scheme, because obviously you take it at 63, so that's going to slightly reduce that as well. But it is an option for those who have been here long term. In terms of the German pension too, it is inheritable. So if there's a husband, a wife, or a legal partner, and one person passes away, they've contributed into this all their days, then the remaining spouse can receive to 55% of that person's state pension. However, though, it can be reduced from 55%, depending on what other income that spouse has. And obviously, if they decide to remarry or something like that, but theoretically, it is inheritable. Okay. You also have the option to delay taking the state pension. And if you decide to delay it, not take it at 67, then actually they're pretty generous. They're going to give you, for each month that you delay, they're going to give you an extra 0.5%, or 6% per year. So somebody who's like in really good health, thinks, hey, I'm going to live, until my 80s, it could be worth the risk to take. You say to yourself, okay, I'm not going to take it at 67, I'm going to take it at 70, and it'll pay me out an extra 18%. Okay. Now, the German government isn't doing this out of the kindness of their hearts. They're doing it because of the hope that, somebody doesn't claim on it and then never ends up claiming because they unfortunately pass away. But it also generally helps as well for them to do it, to have as many people to delay this as possible. So that's why they're basically giving you that reward. And, if you live to the current kind of average age in Germany of, say, 84, 85-ish, and you've delayed it those 3 years, that 18% can be significant value. Okay. And pretty much, those are pretty much the key points I would say, of the German state pension system. I would basically say, to go and explore that website, because there's a lot of useful information on here. And one of the good things too is you can actually, if you want to go and basically sit down with someone, it's possible to do so, because there's offices basically all over. And the only other thing I would also highlight for expats as well, just before I move on, is we quite often get people coming over, maybe only going to stay for a short period of time, say 5 years. Maybe they're they moved over here with their company for a short period. Basically, when you are paying in here, if you then subsequently leave Germany, as long as you haven't been here more than 5 years, it is possible to get back your contributions, not your employer's, just yours. But it takes about 2 years to do that, just to warn you. Okay. Because obviously, if you leave Germany, they want to make sure that you have actually left Germany as well as the EU. Because bearing in mind, if you accumulate credits in Germany, accumulate credits in Spain, it's one big EU system. Okay. But if you do later decide, let's say you're here 3 years and you decide to leave, you go back to the US, or elsewhere outside of the EU, then effectively what it will mean is you can go and reclaim it, but there's a 2-year waiting period before you can reclaim it, just to make sure that you actually have properly left. Okay. And certainly we've had clients that have gone through that and basically successfully reclaimed their monies. So, the key thing is, once you hit that 5-year point, then you're eligible for the German state pension. Okay. And you will then later in life get it. Even if you later leave the country and move abroad or move elsewhere, you're still entitled to that pension. Okay. And yeah. All right. So I'm going to move on to the first layer, I guess, of the private pension system in Germany. And it kind of a little bit works in conjunction with the DRV state pension. Okay, it's known as the Basisrente, or basic pension, also known as the Beruhrrente, after the person who came up with it. It's basically a state-sponsored scheme. Okay, and effectively, how it works is, between the state pension and the Basisrente, it's possible to have total contributions of just over 29,000 euros per year. All right. So, and exactly like the state pension, it being reducing your taxes, the Basisrente does exactly the same. All right. So let's say, though, you're a high earner and you are maximizing out how much you're putting in the state pension. I'm going to say high earner, I'm talking about 70,000, 80,000 euros a year. Effectively, it's going to leave you with roughly 11 to 12,000 euros that could go into the Basisrente, okay, tax efficiently. And interestingly enough, though, everyone has their own allowance. So let's say you have a couple and one of you works, one of you doesn't work. So the person that works, because obviously they're contributing into the state pension, they're going to have a reduction in the amount that they can put in. The person that doesn't, however, work can actually use the full allowance. And because of the fact in Germany you can do your taxes jointly, what it means is that basically that person who is working can utilize this, the credit that their partner has built up. And it means that all of a sudden, rather than having 11,000 reduction in taxes, they can actually have, around 40,000 reduction in taxes. How it generally works, though, is effectively it is a structure that you would go and invest in things like, different types of mutual funds, ETFs, bonds, etc. Whatever you're dependent on, obviously, your risk attitude and capacity for risk, which again, we would kind of work with you to determine as part of a full kind of financial, personal review of your circumstances. Then effectively, we're gonna basically have a portfolio in here And whatever you put in there, depending on your kind of rate of tax and how much you're paying, you will effectively get tax credit back in the end of the year. Okay. So picture that you've put in 10,000 euros into the Basisrente. You're a higher rate taxpayer. Let's say you're paying 40% as an average. And effectively, that 10,000 euros basically only going to cost you 6,000 euros. So pretty good from that perspective because you're getting 10,000 euros worth of value, and it's actually, in fact, only costing you six. Okay. Um, there are some things, and again, we would again go through this with you as part of a one-to-one, more detailed conversation. But things you need to be aware of is you can only access it from age 62 because the Germans are actually the government is giving you this tax relief. They want to make sure that the money is there for retirement, and so that you never have to rely on German state benefits. So the money's locked in. Okay, there's zero flexibility on that. And the other thing too, again, is something to have an awareness of, is that the only people that can be beneficiaries would to the policy would be a spouse or a child. And when you eventually take this, you do take it as an income for life. Okay. So effectively, again, it's because of the fact Germany's quite a conservative country, in my opinion. And unfortunately, they're not giving you that flexibility in this level of pension because again, they've given you all this upfront tax relief. They want to make sure the money is there for retirement and that you're not just going to withdraw it all, go to Vegas and put it all on red. Okay. They want it there for your future retirement. All right. Again, though, it's something that we would discuss with each individual client to determine whether or not this is right and suitable for them. In Germany as well, you've also got company pensions. Okay. So basically, every company in Germany should offer a company pension. It's tax deductible. So as you'll see here, pretty good from that perspective. The maximum you can put in is 8% gross of your gross monthly salary. So a maximum of 644. Obviously, though, it depends on how much the company is allowing you to put into it. Um, the company itself should contribute 15% of your contribution, so it's a little bit of free money up to again the limit that they're prepared to do. Again, with this type of scheme, it's been company pension scheme. It is basically most of them by far you cannot access it until 65. Okay. There are a few styles of these pensions that it is possible to maybe get it earlier, but again, they are few and far between, and they're typically the type of company's pension scheme where they guarantee how much income they're going to give you in retirement. Okay, kind of like based on your final salary, the number of years that you have, etc. They're just few and far between in Germany because they're so expensive. Most of these schemes, what you're going to get is going to be determined by the performance of the underlying investments. And again, beneficiaries will be dependent on the individual scheme as well. Thing I would say about the company pension schemes, I mean, I like free money. Most people do. Okay. Fact that it reduces your taxes as well is a really, really good benefit. Um, I always say to people though, don't just blindly sign up for it. Okay. Because one of the big challenges that you have with this scheme is that if you are more likely to move employers from one to another, the problem is that some of these schemes you can theoretically take to your next employer. The reality is very difficult to do because most employers will sign up with a particular provider and basically to then go and take one provider scheme, move it over to the other provider. It just can be a headache. In a lot of cases, it just never happens. And the challenge is with these schemes is that you have upfront charges built into them, which typically are the first 5 years. So imagine basically you're working for a company for 2 years, you pay 2 years worth of the upfront charges, you move to another company, take out a new scheme, oh, your charges are starting over again. So, it's an important thing to consider. But like I say, it is a bit of free money, it is a bit of tax reduction, it can make sense. Okay. So it's just really important to read through and understand what the scheme details basically say. Right? In Germany as well, you've also got something called a Riester-Rente. don't often recommend these, if I'm completely honest with you. The reason why is A, it's only 2,100 euros that you can put in per year. B, the money's locked in until 62. But the bigger thing is the fact any money you put in here, as well as the government effectively gives you a small tax credit per year and per child that you have. Okay. So they're effectively going to give you like 175 euros every single year. Problem though is that within this scheme itself, any money you put in and any money that the government tops you up with has to be guaranteed to be there at retirement. And that might sound good. Anytime you have a scheme or like this, where the money has to be guaranteed to be there and not just be based on what happens in the marketplace, how well your investment performs, you tend to find that these don't perform very well because they have to basically mitigate the volatility and the risk of any money, not potentially being there at retirement. So they just don't perform well. And when you balance that up against the initial upfront costs that the providers make for this, we don't see a lot of value in it unless you have a lot of kids. So if you have 3 or 4 children, could be worth it simply because you're getting a credit every year for every child and it builds up. I mean, I've got a client, for instance, that has 7 children, basically for him and his wife, definitely worth having it because every single year they're basically, getting credits for nothing. So, and the other thing too is if you invest in this, and then actually you leave Germany, you leave Europe, etc. Well, actually, all those tax credit, the Germans actually take them back. Okay, so you have to physically be over here in retirement, otherwise they take the tax credits back. So again, we often don't see a lot of value in it. Okay, um, the top layer of the system is something called a private renta. And this is by far the most popular form of tax efficient investment in Germany. Um, it's a really good product. There's a but, which I'll explain to you in a minute. It's after tax money, so it's different from here, okay, where you're getting kind of upfront tax relief. This is after tax money. You can put in as much as you want. There's no, limit to contributions. You can technically access it from any age. All right. So it gives you that kind of flexibility, as well as that anyone can inherit this money. Okay. Um, it's there's a whole host of kind of different features. I mean, with this, you can decide to take a lump sum, and as long as you are age 62 and you've held the policy for 12 years, then effectively when you go and draw this down, you will only pay tax on 50% of the capital gains. So imagine you've got €500,000 in capital gains. All of a sudden, basically, you only need to pay tax on 250,000 of those. Pretty good. Okay. The other thing too, it's in a life insurance structure. So with these, they're typically built with like 1% life insurance in them. It gives you a lot of good flexibility because if you leave and move elsewhere abroad, then quite positive thing too, because you can keep on contributing into it. Whereas these, because these are tax efficient in Germany, it means, let's say you move to Holland, for instance. Recently had a couple of clients move there. They operate a very similar system to this. Well, in Holland, basically, you would have to go through all this again, set it all up, something new, etc. Whereas actually, what you could do is if you had a private renta, you just continue on with your private renta, and it protects you from any taxes whilst it's growing, and basically could potentially, depending on where you live, will determine obviously the tax rate that you will end up paying. If you stay in Germany, though, effectively you could go and, as I say, take a lump sum. You can leave the money invested and just draw it down. You can draw down 4 or 5% a year. That way you kind of manage your taxes, etc. And obviously, if you're age 62 and you've invested for at least 12 years, you're still going to get that 50% reduction. You could also as well decide to buy a little bit of income. If you buy income on this, the tax rate's phenomenal, right? Really is. I mean, if you're 67 and you decide to buy €1,000 of income from here, from the money that you built up in your fund, effectively, you're only going to pay tax on €170 of that €1,000. So the other €830 income, you're going to get it tax free for life. Okay. which is, pretty compelling. And, the good thing is too, with a lot of these policies, you can actually decide to do a mix, take a little bit of money out, leave some money invested, buy a little bit of income for life. And that way you've got different kind of ways and sources of how you're taking your pension income. You can borrow against this as well, which is pretty good. You got 100,000 euros in here, and let's say for some reason you need to borrow money, be it a tax bill, be it, I don't know, buying a car or something like that. Don't want to interrupt. It's not recommended to interrupt your long-term savings for your retirement planning, etc. But you can go to a bank, they'll take security, they'll take the Privata Renta as security, and they'll give you a really great rate of loan, effectively. So there are other benefits as well, which again we would go through in much more detail. I'm just conscious of time, but on it. So even in terms of like an inheritance point of view, and avoiding certain taxes on your death, basically there can be a host of other benefits as well. Here's the bug, though, guys. Right? It is the stinker. It basically this is not kind of subsidized scheme in Germany, right? It's not locking your money away like these plans are. Okay. And because of that, essentially you have to, as a US citizen, you need to worry about something that's called PFIX. Okay. And if you're a US citizen, it is not recommended that you take out Privata Renta. And the reason why is basically PFIC is a foreign non-US company that generates passive income. So things like dividends, interest, or capital gains, and produces, basically um, huge tax liabilities in the US. Okay. So if you think about mutual funds, ETFs, or different kind of holding companies outside the US, and investment funds, basically it has a nightmare tax treatment. Okay, so if you owned like something that's classed as a PFIC, essentially the US is going to tax you any gains at the highest tax rate up to 37%, plus interest charges, even if you haven't even sold anything yet. Okay, you can't also claim capital gains treatment like you do in the US, where certain types of investments you hold for 12 months, for instance, and it reduces the capital gains tax. There's also a huge reporting burden. There's a form, which is Form 8621. And for each passive foreign investment company, PFIC, that you hold, okay, you need to fill out this form. And the form is super complex. It's very expensive to file. And literally, for every PFIC that you have, an accountant or a tax preparer is going to charge you hundreds of dollars for every single one. So imagine you've got, I don't know, a fund, and it's you've got, let's imagine you've got 10 ETFs. It's going to be challenging because literally they're going to tax the hell out of you, and as well, it's going to be expensive to file. So, basically, we don't generally recommend the Privata Renta if you're a US citizen. But if you're married to a non-US citizen, they can certainly have one. Okay. And we find that quite often is that what will happen is the spouse, who might not be American, maybe they're German, maybe they're from someone else, they basically go and they will go and take out the Privata Renta for that flexible kind of pension planning. But from our point of view, we would never recommend the Privata Renta simply because of these PFICs. Okay, it's just not worth your time. All right. So the other thing too is that you can also consider, obviously in Germany, is property investment. And we have partners that are really, really good in terms of property solutions. Tax efficient in Germany, okay, and things like expenses can be claimed, so on and so forth. But to reduce your tax burden, okay, and from a U.S. point of view, obviously, there's certain limits that the U.S. aren't going to tax you on your earnings. It's roughly around $125,000 a year that you can earn before earn from income before, you're liable to actually pay any taxes in the US. So, from that point of view, it can be, another option for US citizens. One thing I would say though is, that you do need to be mindful of is that when you come to sell the property, there could be a liability, obviously, to the US. In Germany, after 10 years of owning a rental property, if you decide to sell it, you don't pay any tax on it. It's a pretty good, efficient product from that point of view, solution from that point of view. Problem is, as a US citizen, you're going to likely have some sort of tax liability in the US. Okay. Again, though, I mean, my own self, I own property with my wife. I say I own property. I don't own anything. My wife owns it. It's similar to my wife owns all of my, all of our investments. Because essentially, if I were to put it in my own name, then effectively, I would have the same problem with these PFICs. So the simple solution is all the investments that fall outside of, company type of schemes or government sponsored schemes. Basically, it's in my wife's name because she is not American. And if you're in that circumstance, well, both of you, one or either of you, sorry, doesn't have U.S. citizenship, doesn't have a green card, etc., then that is the simple solution. It gives you access to all these types of different options, which you have in Germany. But property can be a very valuable source of investment. Most of the German population rents. I think it's about 65, 66% roughly that rent. You tend to find as well, and certainly our experience and through information I've garnered through our property partners, it's longer term. People don't move around as much. Okay. And what you tend to find is someone will move into the property and they could be in there 5, 10, 15, 20 years. So, it's less likely that you're going to have a lot of, the same turnover that maybe you would have in other different markets. And again, it's definitely an option that can be explored. And certainly, we work with our clients to help them out with that as well. Okay. Um, the only last thing that I'll say before I hand over back to Tal is, every single person that we sit down with, what I would like to say to you is that, it's very, very important that anything that you take out is obviously in your best interest. It's why every single client will go through a full review of your circumstances, needs, goals, situation, etc. And it's a really valuable experience, whether or not you even decide to proceed with our recommendations. It's still a very useful experience because it really kind of pulls everything into one space and allows you and me, and your advisor to really kind of visualize exactly where you're at, where you want to be, and basically where you want to get there. And all the advice that we give, it's in plain English, okay? And we walk you through every aspect so that there is never any kind of doubt on what you've invested in, why you've invested in it, what the charges are, etc. It's plain and simple, okay? And we purposely do that because we want to give the best service that we possibly can to each and every one of our clients and build that long-term relationship. And certainly that's why most of our clients, also come to us and basically, we do health insurance. So for instance, if you're moving to Germany, you need health insurance. We walk you through the difference between public and private so that you can make an informed choice. Because potentially there are savings that can be made for private insurance versus public. But again, it depends on your circumstances. Okay. You might also need things like life insurances. We don't want our clients to be underinsured, but we also don't want you to be overinsured. So again, that review really helps us to establish, hey, these are the actual needs that I have, and allows us to really kind of give you the best advice possible. Okay. So hopefully that has given you at least, a good initial overview of how the pension system works in Germany, different options, etc., that you might have. And certainly what I would say is if you would like to book in, then we're happy to basically sit down with you, have an introductory chat on a one-to-one basis, and and basically go from there. Okay. So Tal, I guess I'll hand over to you.
Thank you very much. Um,
I'm
yeah.
just going to try and stop sharing. Apologies.
Okay.
Sorry.
Yeah, that's
How the heck do I stop sharing? There we go. There we go. Sorry about that.
that's okay. So, if first of all, thank you very much for the very informative info. Wow, that was uh, mind blowing. I learned a
All
lot,
of it, to
and
be
I
fair.
hope that also.
Yeah.
And I know you tried to keep it short, so I'm very thankful. If someone has a question, please write it in the chat. But I have to say that I also received a few questions in advance, things that I actually think that some of them were not kind of like not in the presentation. The first one is, do I need to join the German system, private or public, if I already have a federal pension, US federal pension?
It depends. Yes, essentially. If you are an employee in Germany, then you need to join um, the German state pension system. Um, there are, if you, there's certain circumstances you don't. I mean, traditionally, if you're self-employed, you can opt out of the German state pension system. Okay. Um, when you say federally, sorry, I'm just want to double check. So if you're talking about the like you are employed by the US government, right? That is a completely
Okay.
different system. Okay. So if you are over here and basically working for the US government, you are conditionally covered by a completely separate set of rules. Okay.
Mhm.
Where you're not even likely paying into the German tax system. Okay, so none of these tax efficient investments would apply to you because essentially you're a government employee. So, and I'll give you an example. My brother actually lives and works here in Germany. He's a government employee. Okay, and he doesn't pay German taxes. He pays all his taxes to the US, right? Basically, does not pay anything over here. So that is a completely different scenario. We're talking about people who are, all these types of things are for people who are literally resident taxpayers in Germany.
And what if someone came to Germany after retirement in the US and using his federal pension in Germany, like basically, paid from the US, but he lives in Germany and he's over 67. So would he have to, can he enter at all to the system, to the pension system?
He's working,
He's
theoretically.
not working. If he's
If
not
he's not
working,
working,
no.
no, because again, you need to contribute into the system in order to receive a pension system. But for instance, if you're getting your US Social Security and basically you're living in Germany, the Germans are going to tax that. Okay. But what's not going to happen is you're not going to pay tax twice. So if the US is taxing you and the Germans are taxing you, right, there's a tax treaty. So you're not going to pay tax
Yeah.
on the same money twice, if that makes sense. Yeah.
Yeah.
So it's kind of so basically, if you're federally employed, I'm just trying to think of the name of it, covered by something that's called the SOFA agreement,
Yes.
okay, which is basically a completely different kettle of
Mhm.
fish to what we're talking
Yes.
about, right? Because essentially, like my brother, he pays no taxes at all in Germany. Okay, he has limitations on how long he can live in Germany, for instance, like it's a maximum of 20 years under the SOFA agreement, and he's kind of coming up to that point. I know, you know. So, but like he would never pay any sort of taxes in Germany at all. So,
Okay.
okay,
Another question is, if I retired already at the age of 45, this is someone that I'm really envy at.
lucky.
I already retired in the US at the age of 45, but I do want to work in Germany. How do I take my pension money to
How
Germany?
do you take pension money from Germany? So, do you mean someone that had worked in Germany previously,
Worked in
and
the
then
US previously,
okay,
retired, moved to Germany.
Okay.
and wants to work here as an employee. Does
Okay.
he keep the pension money from the US? He
Yes. I
got
mean,
corporate pension before.
yeah. I mean, he would still be able to go and claim. They would still be able to go and claim their pension in the US like anything else. So, and then again, if they're working and living in Germany, they would start to build, if they're employed, they would start to build up credits, or if they're self-employed and decided to opt into the German state pension, then essentially they would still start to build up these credits into the German state pension. And then once they reached retirement age in Germany, they would start to claim that. Once they reached retirement age in the US, then they could start to claim that as well. So yeah, I mean, it would be just some case of you're building up these credits. If you later then, I mean, someone going and living and working in Germany, let's say, and then they decide to later actually go back to the States, I would always say to them, keep a bank account in Germany, right? Because it just makes it easier when you go and claim your state pension
Yep.
rather than trying to get the money, in the US. I would personally, because I mean, the Sparkasse will allow you to have a bank account. I mean, even if you're not living here, for instance, or there's other companies as well that will do. So I would certainly keep a bank account so that I'm still being paid that state pension money later on in life. But yeah, I mean, if he wants to move from there to here and work, as long as you've got the correct visa and you're
Yes.
legally entitled to work, which is obviously, Tal, where you will come in and help. With things like that, that's kind of not my remit. But yeah, I mean, they can absolutely do it for sure.
Okay. So I really think it's worth emphasizing that you have to actually work in Germany in order either to be self-employed or employee in order to actually get into the German pension system. Yeah.
Exactly.
Would you recommend for someone who arrived like in a later age, let's say that someone moves here at the age of 35. So he worked a lot of years, in the US and then moved here at 35. Should he
Well,
enter, let's say he's also an employee, but also would you recommend to open a private pension fund?
and it would depend on his individual circumstances. It's really difficult to judge that and see that without knowing their circumstances. So most people will need to do something privately if they want to have a decent income in retirement. That is just, overly relying on the state pension, either in the US or in Germany, in my humble opinion, is creating a risk for you. Is the risk that what happens if you have health issues when you're 60? Okay. And actually, you're not entitled to that state pension until you're 67. Well, actually, if you had a private pension, you could access it early. You could also access it from like 62. And basically, it means you're not going to be in that situation where you're forced to keep on working. The other thing too is, that what you get from these state pensions is just not enough for most people. Really and truly isn't. When you factor in rent or kind of just living expenses, etc., wanting to be able to travel, have a good life, okay, maybe you can survive. Maybe. But who the heck wants to survive when you're in your old age? You want to be comfortable. I don't want to be thinking, can I turn on my heating today or not? And unfortunately, that is a reality that is happening because people are overly reliant on the state pension. If you want flexibility, if you want choice and control, that to me is the key reason why you take out a private pension. It's about choice and control, basically, rather than being dictated to you. It's exactly the same reason why we get a lot of clients over here that take out private health insurance versus public health insurance. And the main reason is because it's choice and control. You can choose the level of health insurance you want. You can control exactly, what experience that you have, as opposed to being on public. It's good. It's a good service, etc. Don't get me wrong, but you will find that there are waiting lists on the public side of things. And it's great in an emergency, but for certain quality of life services, if you can be in private, there are definitely benefits to doing so. And again, we help clients with that as well. Um,
Right. So I think that we're going to stop here. And if anybody has any other questions, so we would put your contact details in our email, and also on YouTube, it's going to be mentioned. And it was lovely hosting you today. And I very much appreciate you coming here and share all this knowledge with us. And thank you all for coming. I appreciate your time, and see you next webinar.